Welcome back everyone to Amalgamation series of videos that we were discussing. In the previous video we did till purchase consideration and I told you that in this video we'll start with our accounting entries. Now accounting entries needs to be done in two parties books, one in the books of transferor, other in the books of transferee. Transferor is the person who's winding up his business. Transferee is the one who's taking over the business assets and liabilities of transfer. Transferees accounting is regulated by Accounting Standard 14. We have two methods, one pooling of interest method and the other one that is for purchase method. But in the books of transferor, how should it be accounted is not told to us by Accounting Standard 14. So we follow generally accepted accounting principles to do this accounting. So we'll start with accounting in the books of transferor company. Shall we? Yeah. And in the next video, we'll be doing accounting entries in the books of transferee company. Transfer of assets to realization. Because the transferor is getting closed, transferor's business is getting closed, we need to close all the accounts. That is asset accounts and liability accounts. So we'll close all the assets and liability accounts by transferring them to realization. Let's first see what is to be done to close the assets. Assets have debit balance. We need to close them by crediting and the debit will be given to realization. You get that? So the journal entry that we need to pass is realization account debit to assets. And in the process of this entry, we need to transfer all the assets to realization account at book value, irrespective of the fact whether this asset is taken over by transferee or not taken over by transferee. See, there is a possibility that transferee might take over this asset in the process of amalgamation, and there is also a possibility that transferee will not take over this asset in the process of amalgamation. We need to transfer this asset to realization account irrespective of the fact whether this asset is taken over by transferee or not. Why? The answer is pretty simple. If the assets are taken over by transferee, it will be taken over from realization account and we write that purchase consideration due and receivable in realization. So it goes there. If the transferee doesn't take over assets, we are not going to continue business. Our business is liquidating. The asset is taken over by transferee, good. If it is not taken over by transferee, we will sell this in the outside market. So I have to mandatorily transfer it to my realization account irrespective of the fact whether it is taken over by transferee or not. And such transfer is at book value. Now there are certain items which need not be transferred. What are they? If there is any P&L account debit balance or expenses which are not written off, those will not be transferred to realization. Why? See, you do this in partnership also. In the chapter of partnership, whenever you do realization approach, you transfer all the assets to realization account, but not P&L account debit balance, not reserve. Why? They'll be transferred to capital account. Such losses should be adjusted against the amount payable to shareholders. So we'll adjust it there. So we'll not transfer P&L debit balance or any such expenses not written off will not be transferred to realization. So what about cash and bank? Cash and bank, it depends. Cash and bank needs to be transferred to realization if it is taken over. If it is not taken over by the transferee and the transferor keeps this cash with them to settle some liabilities which are not taken over by transferee or settle the purchase consideration payable to shareholders of transferor, in that case will not transfer cash to realization. Let me summarize this. All the assets should be transferred. See here, all the assets should be transferred to realization account, whether taken over. All the assets and liabilities should be transferred to realization account, whether taken over or not, at what value? At book value. Very important. Exception: cash and bank when not taken over. When it is not taken over, will not transfer. Why? Like they are not taking over cash and bank as an asset, they might not be taking over certain liabilities as well. Whenever they don't take certain liabilities, those liabilities we are going to pay it off from our pocket as a transferor. To pay that, we need to have money. We'll use this cash. So cash will not be transferred to realization account in that case. In the absence of specific information, it can be assumed that it is taken over. See, the PDF is comprehensive. It will tell you everything. When to do, what to do. If not mentioned in the question, then what to do. If it's mentioned in the question, then what to do. Everything will be told in detail in the PDF. Yeah, you can access this PDF. You just ask me, I'll share this PDF with you. I'll be more than happy. In fact, in the past videos when we did marathon revision for last attempt also, I shared a similar PDF with you all. So my name is Rajavardhan and I'm available across the platform. You can just search for me and then find me, ping me, I'll share this file. You can search for accounts man as a word and you'll find me. Yeah, got that guys. Then I also mentioned to fictitious assets, accumulated losses are not transferred to realization account. Instead, they're transferred to shareholders account. And the journal entry, like I mentioned, will be realization account debit to assets account. Realization account will be debited and the credit will be given to assets account. Now all the assets are transferred. Similarly, we need to transfer all the liabilities to realization account. So again, when we transfer liabilities, what is happening here? Yeah, before that, one more thing. Agreed value is never considered. Remember that. This is a very important point. I've been telling here it should be at book value. When I say book value, I mean that it should not be transferred at agreed value. Agreed value is never considered. It is only considered in, where is it considered? Can you guys guess the answer? Computation of net assets taken over. Yeah, in the books of transferee, when we compute net assets taken over, only then you will consider the agreed value. Till then, you will never ever touch agreed value. You will not consider agreed value. It's always at book value. It's always at book value. So this is the first entry. I'll give you a 10-second small breather if you would want to take down this or take a screenshot. Yes. Okay. I hope you copied this. Next, we are discussing accounting entries for transfer of liabilities. Now, when we transfer all the liabilities to realization account, liabilities are reducing. Liability, when it reduces, it has to be debited. So our accounting entry will be liability account debit to realization. And we'll transfer all the liabilities except whether taken over or not, all the liabilities will be transferred at book value except share capital, reserves and surplus. Share capital and reserves and surplus will not be transferred to this account. It will be always adjusted in the shareholders account. We'll open one account called shareholders account to which we'll transfer all the share capital and all the reserves, including that negative reserves, debit balance not written off, all that. Yeah, see here, all the liabilities, external, all outsider liabilities, that is external liabilities, should be transferred to realization account at what value? At book value. We are never going to touch agreed value. If in case they have given any agreed value again, that agreed value will come in computation of net assets taken over as a working note in the books of transferee. In the books of transferor, you will never consider. Get that? Yeah. So items not to be transferred. Which items should not be transferred? Items that should not be transferred are share capital. I'll highlight it in a different color. I can highlight it in red, but if I highlight it in red, nothing will be visible. Yeah, share capital, reserves and surplus will not be transferred. Why? This share capital and reserves and surplus, we are going to transfer them to shareholders account. We will transfer them to shareholders account, so we cannot transfer them to realization. And the entry is liability is reducing, so debit them, and the credit will be given to realization account. I hope everyone understood this. Then going further, we'll write the entry for purchase consideration due. Now, we transferred all the assets and liabilities to realization. Now, realization is like a box, and this box will now be gifted to our transferee, and we'll ask money from transferee. Because this box of realization consists assets and liabilities which are transferred to transferee, that box is going out. So that box will be credited. That box is realization. And because we gave that box, transferee is under an obligation to give us money. I am transferor. Transferee is under an obligation to give me money. So he's supposed to give me money because I am supposed to receive money. To me, it is consideration for transferring those assets and liabilities. Such a consideration, what I'm supposed to receive from our transferee, I'm going to debit my transferee account. This is representing the purchase consideration due. So, an entry for purchase consideration due will be transferee company account debit to realization account. Transferee company account debit to realization account. Transferee company account debit because we're supposed to receive from them. Realization account credit because we're transferring the assets and liabilities which are now in realization. Once we write this, next we need to write the entry for the purchase consideration that we are going to receive from our transferee. Get that? One moment, guys. Sorry, guys, a small interruption. I had to run to open the door. Great, I'm back. So as I'm back, let's continue. So we're discussing the recording purchase consideration due. Once the purchase consideration is due and later when we receive purchase consideration, as a transferor company, I receive purchase consideration from transferee in various forms. I can receive it in the form of cash, I can receive it in the form of check, I can receive it in the form of debentures of transferee company, by way of equity shares in transferee company, by way of preference shares in transferee company, or much more. So in whichever form I receive, remember we need to debit all of this, because for the transferor company, which I'm liquidating, I'm transferring my assets and liabilities to them. They are giving me cash, they're giving me check, they're giving me debentures, they're giving me equity shares and preference shares. So I'm receiving all of it. So I'll debit it. What would be the credit aspect? I would credit my transferee company. If you remember, here we have debited transferee company when the PC is due, because we are supposed to collect money from transferee. Now when the transferee gives me money, it is no more a receivable. Because it was receivable, I debited transferee company. It won't be a receivable anymore because I would have received money. And for this reason, I would be crediting transferee company account and debiting PC in any form that I receive. Let's go ahead, see the entry. It would be like this. For the receipt of purchase consideration, it is cash account debit, bank account debit. It's not like mandatory. If cash is received, you will debit. If cash is not received, you will not write. Then you'll write equity shares in transferee company debit, preference shares in transferee company debit, debentures in transferee company debit, and the credit will be given to transferee company. That receivable that was previously debited will be closed now by crediting. Receivable which was previously debited here is closed now by crediting, and by passing this we have received PC. Now what we need to do is we transferred all the assets to realization, all the liabilities to realization. We packed that box. That realization is taken by transferring. They were supposed to give us money, they've given us the money. Now two things needs to be done. When transferee took that box, he threw some items out of that box and then he took, meaning some assets are not taken over by transferee, some liabilities might not be taken over by transferee. So we need to account for those assets and liabilities of transferor which are already transferred to realization but not taken over by transferee. Let me repeat. We need to account for assets and liabilities which are transferred to realization but not taken over by transferee. As transferor, I need to sell these assets, collect the money, and settle my liabilities by paying the money. We repeat, I need to sell these assets, collect the money, and pay this money and settle my liabilities. After this, the cash that is left with the cash that is received by way of consideration and all other forms of consideration received, I am going to decide how much money needs to be given to the shareholders, which shareholder, equity shareholders how much, preference shareholders how much, is there any premium to be given, and we'll give all of this to them and then distribute PC, and that will be the end. And in this process of collecting money, selling assets, settling liabilities, we might incur some liquidation expenses. For such expenses also we would have to write entry. And on the whole of this, we might end up paying more money to our shareholders or sometimes less money. If you pay more money to our shareholders, it is realization profit. If we don't have enough money to pay our shareholders, we pay them lesser than what is belonging to them by way of capital with reserves. Such is realization loss. Great. Chalo, let's see. Now the entry is for assets not taken over. Whenever assets are not taken over and we sell it, what is the entry? Usually you say for the sale of assets, the entry will be bank account debit to assets. But here we are not going to write bank to assets. We are going to write bank to realization. Why? The asset account is no longer in existence. The asset account is already closed by transfer to realization. Let me repeat. Asset account is already closed by transfer to realization. So we'll no more create asset. Instead of crediting asset, we'll credit realization account, and the journal entry for sale of assets will be bank account debit to realization. This bank to realization entry, whatever we have here, this bank account debit to realization account entry needs to be passed at selling price. We will pass this journal entry at selling price. We are not going to account for cost price of assets sold, selling price of assets sold, profit or loss on sale of the asset. Not going to consider on. Why? We have transferred the asset at cost to realization or book value to realization. We'll put the sale consideration to realization account. And in the realization account, we'll arrive at profit or loss, which will straight away give impact to shareholders, and we don't have to try to account it separately. So remember this very clearly. Don't try to adjust cost price or book value with selling price to identify profit or loss. Straight away write the entry at selling price, and you already transferred book value. Net impact profit will automatically impact shareholders by way of realization profit or loss, and we don't have to account profit or loss on sale separately. Got that? Yeah. Have a look at this. Entry is to be passed at selling price. Ignore the cost price or book value. Don't try to account profit or loss on sale. Done? The next thing that we need to keep in mind is, what if we have four assets and transferee takes over three assets? They don't tell anything about that fourth asset. They've neither told that it is sold, nor they've told they've not told that whether it is sold or not, and they don't mention the price. Then we would have to make an assumption that it is sold or not sold. If it is sold, at what value? So here comes our conservative or prudent approach. We need to assume that that asset is sold but for no value. Its value is almost zero. It's basically scrapped. Why? If it was sold at a price, they would have told us. Because they didn't tell, by conservative and prudent approach, we will assume that this asset will realize nothing. But I'll tell this to you a little later, just another minute later. When we come to liabilities, this will not be our approach. In liabilities, our approach will be fully ulta. In liabilities, our approach will be ulta. Why? Again, prudent approach, man. If there is a liability transferred to realization account, but it is not taken over by transferee, we would have to settle it. I will not assume that because they have not mentioned that it is settled at 0 rupees. No, unless they mention it, we will not treat it as profit. So we will assume that it is settled by payment of full amount. However, for an asset, what do we do? If nothing is mentioned, we'll assume that it is settled at 0 rupees. Yeah, read this. In the absence of specific mention about selling price, assume selling price as 0. 0. Remember this Shah Rukh Khan's movie? 0. We should assume it as 0. What do we assume it as? 0. It realizes 0 rupees. You get that? So this is with regard to sale of asset. Now let's see settling liabilities. If there are liabilities transferred to realization which are not taken over by transferee, we need to settle this liability by payment. When we pay, bank account has to be credited, and we usually debit liability account. So journal entry for payment is liability to bank. But in this case, we will not be writing liability to bank. Why? Pretty simple reason. Liability account is no longer in existence for us to debit. We don't have liability account any longer to debit it. We've already closed liability account by transfer to realization. So we will now have to write realization account debit to bank. And when we write this entry needs to be written at settlement value. We'll write this entry at settlement value. We are not going to write the settlement value and then the book value of the liability, adjust them to identify the profit on settlement, loss on settlement. Don't worry. Irrespective of what was the book value of the liability, this entry will be always written. This entry meaning realization account debit to bank account entry will always be written at the settlement value. Get that? See, entry to be made for settlement value. Ignore book value of the liability. Don't try to separately account profit or loss on settlement of liability. Why? That profit or loss will straight away impact realization profit or loss, which in turn goes down to our shareholders account directly. We don't have to account this separately. Done? And if nothing is mentioned, by way of prudence, we'll assume that this entire liability is settled at book value. See, in the absence of specific mention about the payment, assume it to be settled at what value? Book value. There you have it. Sorry guys, take a sip of water. The throat is little itchy. Done. And in this entire process to sell all these assets, to settle all these liabilities, we would incur some expense. The expense that we incur to make this happen is called realization expense. What expenses are they? Realization expenses. Such realization expenses incurred will be accounted like this. This has to be paid by us. We are transferor. We are transferor and we need to pay. If I pay, usually journal entry for expenses, expense to cash, expense to bank. Here we cannot write any expense separately. All the expenses will be transferred to realization account because that is where we identify our profit or loss on real. So instead of writing expense account, because everything is getting closed, I'll write realization account debit to bank. If this is borne by me, then there is no separate transfer entry. See, usually we write the entry expense to cash or bank and then transfer it from writing P&L to expense. So there is no need to transfer this to P&L. Why? P&L is also closed by transfer to shareholders. And here we are transferring straight away to realization account, from where we'll find realization profit or loss, which will again go to shareholders account. So don't have to try to identify and transfer this separately to my P&L account. Straight away write it realization to bank and let it affect our what to say realization profit and loss. There is no entry. What is this? For expense borne by transferor, there is no entry. Sir, what is this? No entry, no entry. Salman Khan, Anil Kapoor, Bipasha Basu, Lara Datta, no entry. God, I hope you guys like it. I put in a lot of thought in making this material. Made it like as much to the modern times and trend as possible. Done. The next step. If this expense what we paid was reimbursed by transferee, see it is our expense. I am transferer, it is my expense. I would have to pay. But transferee is little kind-hearted. They'll be okay. Wherever dying, I am taking over your business assets and liabilities. Take this liquidation expenses. Like when someone dies and then you go to see them, you pay some money, because of all the work that they have, then all the expenses that might be there, like that. What if transferee pays us money? So we're receiving money, so we'll debit bank account. I am transferor here, I'm the one who's closing the business. I'll debit bank account. Credit, it is income or it is decrease of my past expense. That expense, no, it was debited to realization, so this income will also be adjusted there. So if I receive any realization expenses that I have paid as a reimbursement from my transferee, entry will be bank account debit to realization. See, reimbursed by transferee, entry will be bank account debit to realization account. Got that? What if this realization expense of transferor is paid by transferee? No, it is my expense. My company is liquidating, I have to pay. But transferee comes forward and pays that money on my behalf. Is that possible? Very much possible. What if transferee pays? Then what do we do? Expense will be okay, paid by transferee. If transferee pays and then transferee is bearing that expense, we will not write any entry. Why? He is paying. He is recording as expense. Why will I write entry? I will not write an entry. He will record the entry. He will pay the entry. He will book the expense. I will not write it. So if the liquidation or realization expenses is paid by transferee and borne by transferee, will not write it. However, if it is paid by transferee and is asking me to reimburse that expense to him, if I am under responsibility to reimburse this expense to him, then I would have to write. I would have to write entry. It is paid by him. I have to pay. When he pays, no entry. When I pay him, I'll write again realization to back. So basically, when I reimburse, I'll write the entry realization account debit to bank. This is the same as the entry that we passed initially when I paid straight. So it doesn't matter whether I pay expenses directly or my transferee pays and I pay the transfer. Ultimately, my money is going out and it's expense to me. So as transferor, my entry will be realization account debit to bank. Get that? After this, we'll identify the money that is supposed to be paid to preference shareholders. Preference share capital account will not be transferred to realization. If you remember, the second entry we transfer all the liabilities to realization account. We'll transfer all the liabilities to realization. In this entry, where we transfer all the liabilities to realization, we are not going to transfer share capital, meaning equity as well as preference. So what do we do? This preference share capital account will now be transferred to preference share holder account. Will not transfer to realization. From preference share capital will transfer to preference share holder. Preference share capital is decreasing, so we will debit preference share capital account. Preference share holder is a liability increasing, so we will credit preference share holder account. So my entry will be preference share capital to preference shareholder. But this entry will not be at book value. I'll show it to you on the next. Purchase consideration payable to preference shareholders. So what will I write? My preference share capital account I'll debit, preference shareholder account I'll credit. This preference share capital account what I've debited, this will be at nominal value. But this preference shareholder account what I'm crediting, this will be at PC amount that I'm supposed to pay to them by way of the exchange ratio or whatever. This nominal value on PC need not be same. Sometimes we might have to pay more than nominal value. If we pay more than nominal value, that is what we call as premium. Premium on basically redemption. This premium on redemption is expense. Expense on liquidation, you will debit to realization. Any expenses will be debited to realization. It doesn't matter what expense it is. Expenses, debit to realization. So what will we write? We'll write preferential capital account debit, realization account debit to preferential capital. However, if you're paying less, nominal value is 1 lakh, but we're giving them only 90,000 worth shares in the new company. So what are we doing? We are discounting them. So I'll write here next discount. So if there is any discount on this settlement, such a discount is income and such discount will be credited to realization account. If you're paying more than the nominal value, such an amount is loss and it will be debited to realization. So basically any profit or loss will debit it or credit it to realization account. Amount payable to preference share capital, amount payable to preference shareholder credit. Preference share capital is decreasing. That's the entry. Then payment to preference holders. You can pay them by giving them equity shares, preference shares, debentures, cash or whatever. Because you are giving them this payable of preference shareholders account, whatever you credited here, has to be nullified. So we will debit it. Get that? So I'll debit my preference shareholder account and whatever we give them will credit. X% preference shares in transferee company, equity shares in transferee company, debentures in transferee company, cash or bank, everything will be credited. If in case there is any premium also no on this premium on these shares given equity share we are not going to account it. Why? Such premium on issue is for transferee company, it is premium, not for transferor. See, a share of rupees 100, if transferee company gives to it at an issue price of 120, we will write the entry at 120. We will not try to account that premium separately. Why? For us it is investment, for us it is not share capital. For transferee it is share. When transferee books the entry, transferee will write 100 rupees to nominal, 100 rupees nominal value to share capital, 20 rupees excess money to premium. Transferee will write, not us. That we'll discuss in the next part of the video. So in this third part, we're discussing accounting entries in the books of transferor. Next part, that is part 5. Part 4, we'll be discussing accounting entries in the books of transferee. Got that, guys? So for the payment of purchase consideration to preference shareholders, we'll debit preference shareholder account and then credit all forms of PC that we give them. Preference shares in transferee company, equity shares in transferee company, debentures in transferee company, checks as well as cash. Then we need to identify how much money is payable to equity shareholders. Before that, we need to close our realization account and identify realization profit or loss. All the assets and liabilities transferred, PC received, assets not transferred, sold, liabilities not transferred, settled alongside with realization expenses. Is there profit or loss? And even we would have to consider premium payable to preference shareholders on redemption or discount on redemption of preference shares also. Once we consider all of this, if there is realization profit, that will be credited to equity shareholder account because it will increase the money that we should pay them. If there is realization loss, it will be debited to equity shareholder account. That's it. See here, realization profit. Credit equity shareholder, debit realization. If it is realization loss, debit equity shareholder and credit realization account. This is the closing entry of our realization. This profit or loss will be usually found as balancing figure in our realization account. When we prepare realization ledger, this is the last item that we find there. You get that? And such money is transferred to where? Our equity share holder account. And now we need to transfer last two items that is remaining in our balance sheet. What items, sir? We transferred all the assets to realization, all the liabilities to realization, except capital reserves. And then that realization is taken over by transferee company. They gave us PC and realization expense over. We closed realization account also. But capital what was not transferred to realization. Preference share capital we transferred to preference shareholders, gave them PC, closed that account also. But there is still equity share capital account and remaining reserves pending. That equity share capital account and the reserves what is remaining will now be transferred to equity shareholder account. So what items will go to equity shareholder account? Equity share capital, reserves and surplus, realization profit or loss. All the three will be transferred to our equity shareholder. We've already done transfer of realization profit or loss. So now in the next entry we'll transfer share capital and reserves. Have a look. Transfer of equity share capital and reserves including accumulated losses to equity shareholders. Share capital will have debit balance. To close it, we need to, share capital will have credit balance. To close it, we need to debit it. Reserves also will have credit balance. To close it, we need to debit it. And we will give credit to equity shareholders. This much money should belong to equity. If in case there is any accumulated loss, this will have debit balance. To close this, we need to credit it. So we will basically credit such accumulated losses and transfer it to equity shareholders. Now we have in our equity shareholders account entire money that is payable to them. We received PC in the form of shares, debentures, cash and all. Part of it is given to preference shareholders. So after giving to preference shareholders, whatever is remaining, all that should be distributed between equity shareholders. So finally, in the PC receipt entry, we have debited equity shares in transferee, preference shares in transferee, debentures, cash, bank. All that will be credited here, because we are settling. See, 2x% preference share capital, 2 equity share in transferring, 2x% debentures, to cash and bank, and will finally debit equity shareholders. Why are we debiting equity shareholders? In the previous entry, we have written the payable to equity shareholders. Now we are paying it. So there we had credited, now we are debiting. Here it is payable, here it is paid. And this is the closing entry. Once you write this entry, there would be nothing left in the books of transferor. Transferor stands liquidated. Got that? One point that I told previously when accounting for preference shares, but I'll tell once again because it's important, is when you give this equity shares, preference shares, debentures to shareholders of transferor company, if these shares include premium, we don't care. Don't try to write security premium account. Write the entire issue price. A share of rupees 100 issued by transferee to transferor at 120. We'll receive it at 120. We'll give it to shareholder at 120. 20 rupees premium, 100 rupees nominal value. Separation will not be made in the books of transferor. It is premium for transferee, and premium will be booked in the books of transferee only, and not in the books of transfer. Got that? This is it. Is the entry, and by this we close the entries in the books of transfer. They might further ask you to prepare ledger accounts in the books of transfer. Whatever ledger they ask, we can prepare it based on these general entries. However, if they don't mention the ledgers and ask us to prepare necessary ledger accounts, what ledgers to prepare? See here, prepare ledger accounts, so asked in the question. If question says prepare necessary ledgers, what should we prepare? We should prepare realization account, transferee company's account, preference shareholders account, and equity shareholders account. These are the 4 ledgers that we prepare when they are generic and use the word necessary ledgers. Got it? Now, before I end up this video, I'll show the answers to you every solution, every entry at about like 10-15 seconds, so that you can take a screenshot if you want, or pause it and then copy. I'll just run through it, fatafat. You guys can see through. Accounting entries in the books of transferor company it is. First entry. This is our first entry. Then we have the next entry for liabilities transferred and PC due. I'm showing you 2 entries. Let go. Next we have receipt of PC and assets not taken over settlement. Then settlement of liability and realization expense paid by transferor. You can pause and then copy. I'll just give you 10 seconds time so that you can pause if you want or take screenshot. Not like proper copy time. Then liquidation expense paid by transferee and purchase consideration payable to preference shareholders. Done. Now settlement to preference shareholders and realization profit or loss. Done. Last one, payable and payment to equity shareholders. Amount payable, PC payable to equity shareholders and payment to equity shareholders. Note on ledger. That's it. And in the next part, we'll be starting with accounting entries in the books of transferee. That's also going to be a lot fun. I've tried my best to make it as fun as possible and as interactive as possible. Thank you guys for your patient listening, and I hope I've made sense, and I hope you people have understood amalgamation. Yep, we'll be waiting very eagerly to see you all in part 4 to amalgamation, wherein we'll discuss accounting entries in the books of transferee company. And in part 5, we'll be doing problem. Great, that's it. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So the thumb rule to stay happy is pretty simple, just to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? The answer is pretty simple. Yes, we are in the game. I hope that's your answer. See you all in next part. Till then, stay in the game. Tata, bye bye. Take care and get lost.